still a lot of sort of misguided thoughts around VC that like they're doing you the favour. No way. You're doing them the favour. You're helping them. I think somebody talked about FOMO and stuff. It is certainly true. I know VCs who've invested in deals they knew they would lose money on because they wanted the logo on their website. It's a very hard world out there. It's not unkind. It's just hard. You know, I mean, these people are hard because they've got a very specific objective. It's not all soft and fluffy. But with AI now, genuinely, I mean, we're beginning to adopt AI. You know, you should be able to get your business up and running and be selling things unless you've got a very hard physical manufacture job. All the most famous people I've met, and I've not met by any means everyone, but I've met enough who've been very successful. None of them do it for the money, but they would sort of start again tomorrow if they wanted to, because they're doing it for the intellectual satisfaction of something that's driving them is something in their past where for some reason somebody didn't understand them. You will have a better chance of getting a higher valuation. But I'm sure you've read all the stuff on LinkedIn that investors need to make money out of the power law. Do you know what the power law is, everybody? Yeah, so they need the outliers that perform extraordinarily well to give them the return on the portfolio, which sort of, I always think of it in amateur language, it makes up for the deals that they fail to make money on. And most of the deals they do fail to make money. I was reading the other day that Andreessen Horowitz, I never know how it's pronounced, but A to Z it's called. They are... so A16Z, which is big US VC, they have still not returned to their investors all the capital invested in their funds. So most of their value, even though they're one of those brilliant firms in the world, is still on paper and not actually being returned. So VCs, when they invest in you, are looking for an outlying return. What issues do you think help them achieve that potential? Do you want to give me a shout out on how you think, if they're think about that outlying return, what do you think?
It's a crazy number that was said yesterday by Harry Stebbings. So he said it used to be double, now it's triple.
Yeah. Yeah, I mean, it's really, really hard for them to make good money. And I think something like 90% of VCs don't return money on their funds. So this idea that it's a sort of, you think it's really hard for a reason. Yeah.
I think part of the reason is the market from a VC perspective got carried away over the last couple of years. And therefore, the likes of Andreessen Horowitz, Stebbings, and all these others, they talk about their winners, right? This is the portfolio that we have. There's that FOMO of, we need to get in on this one because we missed the last one. Have you really got a route to market that is differentiated from the rest? And depending what level that they're coming in, I look at the recent valuation of Mako, which is obviously a huge health tech business, 7 billion valuation after 20 months, right? That's like Series C or Series B, right? I don't care how good Daniel Ek is from Spotify, but it's at that point, it's already top heavy.
Yeah. I think, let me try and give you like the one-on-one on VCs. So first of all, it's not their money, so they need to try and return it to someone else. So the first thing they're doing is look to protect their downside risk, which is at least get their money back. This is why they they have these preferred shares. Do you know about preferred shares and how they work? Has that been explained to you? Yeah, some of you are nodding. Some of you, do you all understand, or would you like me to give a quick 101 on that? You would like a 101. Okay. So ordinary shares, I'm sure you know, an ordinary share, typically it owns the ultimate equity. So if things go really well, that's where you really make out like a bandit. But anything ahead of that, whether it's debt or preferred, gets their money back first before the ordinary equity. So when it goes really well, the people who are getting a more limited return but getting their money back first do better. But when it's an amazing return and billions, people with the ordinary equity do better. So what VCs are looking to do is protect their downside risk. They tend to do what's called preferred. They often call them A-ords. But what they do is they say, I can have my money back as the first situation when there's a distribution of capital. A distribution of capital might be equity, but it might be other situations. So if you're doing a buyback, all sorts of things that mean you're distributing capital to shareholders. So they would get their original capital back, and then usually it works two ways. Either they say, I will have my capital back, or I will come and effectively join the ordinary shareholders and then share in those returns equally. Or sometimes they say, I'll have my money back and I will also share with the ordinary shareholders. So a way of thinking about this is, imagine you're in a room, you sold the business, and round the table is full of money, cash, loads of notes. And round the table are all the shareholders who are waiting to put their grubby paws on the table and grab the money, their share of the money. When there's preferred shares, what happens is those shareholders say to everyone else, if you're not a preferred shareholder, leave the room now and we'll take our share. And then in some situations, they might say, we'll take our share, and then they leave the room and let you all back in again. Sometimes they stay in the room and let you back in again and then start sharing. And where you have what's called a waterfall with lots of classes of different shares, you will have a sort of cascading order of people who are sitting around that table taking some money and then letting other people back in the room to take their share. The worst I've heard is somebody who sold a business for £600 million. Guess how much the founders took off the table? No,
20.
it was 100 million, actually. It was 100 million. What do you think the founders got of the 100 million? I think they actually technically owned like 18% or 20% of the ordinary shares. What?
20 million?
No, 600 grand.
Wow.
Okay, so a lot of founders don't really understand that when the investors put in these stacks of shares, they're always going to be ahead of you. At best, they might opt to join you because they'll make more money from joining you rather than taking their original capital back, if that's what they agree. But they need to try and protect their downside risk again from their investors, and don't be naive about their position. The other thing is they will invest in on one level, valuation does really matter. On another level, it's also about balancing the portfolio. It's about, are you going to become the power law company? If you're not the power law company, very quickly, it sort of almost doesn't matter because they're just not going to make the amazing returns out of you. However, the more rounds you do, the more you get diluted. I think it might have changed a bit, but there's definitely a sort of every round takes 25%. So if you've got, it's one of the reasons for not having too many founders in your business. So you've got 3 or 4 founders. Every time a new investor comes in, you all get diluted, and very quickly, each of you only has a tiny percent. I was reading something on LinkedIn last night which said, now founders, often if they go through these series A, B, C, D, they end up with less than 10% of the company.
Okay, but if you've got to level D, you're doing it at a far greater valuation, and you should have been selling on any of those rounds as well.
But possibly, but not definitively. You won't definitively be allowed to sell out your shares on the way through. You might, but not always. And anyway, you need to be becoming a sort of unicorn for these sorts of rounds of fundraising to still mean you make money. And remember also, when they invest, they start taking control of your life. So by Series D, they can sack you if they want. So if you're going to play that game, you have to go in with your eyes wide open, and you definitely have to be ambitious to do the, tens of millions, hundreds of millions exit. Exactly. And I think there's still a lot of sort of misguided thoughts around VC that, like, they're doing you the favour. No way. You're doing them the favour. You're helping them. I think somebody talked about FOMO and stuff. It is certainly true. I know VCs who've invested in deals they knew they would lose money on because they wanted the logo on their website because it was fashionable. And they have this fear that if they don't do that, the next great person won't come along. I'm seeing quite a lot of chatter about, we need to be in the room before the founders have thought about being founders right now, all this sort of bollocks. So you're like, guys, wake up, how are you doing it? But you can't control how they run their businesses. You can only play with them. And some of them are absolutely brilliant. I mean, what they can do in terms of adding value. But I think the harsh light of most businesses, do you know what the average sale price for most businesses in pretty much every country in the world is? So ignore the currency, think of the number. What do you think most companies sell for less than? Give me a shout out. Most companies that trade sale, what do you think they sell for less than how many, let's say, million? So do you think it's less than 1 million, less than 5 million, less than 100 million? What do you think the number is?
Less than 5.
A couple other people have a guess?
Less than 10.
A couple more guesses?
It's lower. It's lower than
Less
5.
than 25. Less than 25.
It's actually less than 20. So even in the US, where you think these things are all bigger and better, most companies sell for less than 20 million. There's a vanishingly small number of companies in the UK that manage to make more than 2.5 times EBIT, 2.5 million EBITDA. Are any of you anywhere making 2.5 million EBITDA? No, okay. So let me give you like the 101 on why prices are that. Most buyers who buy companies want something called payback. They get payback from the profits of the company they've bought. They expect those profits to pay back the capital they spent buying you. Most companies, most people, most buyers of companies, so trade buyers, forget VC investors, most of them want payback in 3 years. So if you're making 2.5 times 2.5 million EBITDA, they're going to be looking to pay about 7.5 million for your business, so they can get all their money back in 3 years. So why then do you get these outliers where you suddenly hear about companies selling for billions of pounds? So why do you think some companies suddenly appear to sell for billions of pounds when in the rational world, most buyers want their payback in 2 or 3 years? What do you think causes people to suddenly pay £1 billion for a business, which might still be quite small?
Is it how you might change that business, not your business?
Correct. It's because, for example, if you've got a piece of software and you sell it to Oracle have got 10,000 salespeople around the world. If they can add 100 grand to every salesperson, guess what? In whatever, you can all do the sums better than I can. Within a year, what's their payback? Within 2 years, what's their pay? That's what they might pay for your business, because they're still getting payback. But they're not doing it because they think you're marvellous. They're doing it because they can see that they can grow their own sales and profits by a magnitude of X, because they've got scale and you haven't. Yeah. So this is why often people think these things are just miracles. They're never miracles. So some very hard-nosed, rational people making very, very rational decisions about how they're going to improve, particularly if they're big listed companies, how they're going to improve their earnings per share so their stock price goes up.
But it's cheaper for them to buy it than for them to build it over 2 or 3 years.
Can be, yeah. Or just that might be their model to buy companies. You see all sorts of different models. But the crucial thing is that I think a lot of founders don't really understand is it all actually starts with the exit price. And the exit price is largely, sometimes you can IPO, but IPO windows are not open. The IPO market's not open all the time by any means.
It's also not the Holy Grail.
No.
Do you feel, Modwenna, with the introduction of the London Stock Exchange Pisces market, which is going to be trying to ramp up IPO activity, will that help? Will that help give founders potentially another route to exit and more choice and great liquidity, apparently?
Okay, so the first thing, the Pisces market is not the London Stock Exchange. Pisces is a Bank of England initiative. Right. There are several Pisces markets. The one I'm particularly keen on is called Asset Match, because I was a non-exec, and it's the only one I know that's actually profitable as a business in its own right. So this is one of the other things. Did you know the AIM market has never made a profit ever since it was started for its owners? So it's not surprising it's a bit pants, because how many of you want to spend your years and years investing in something which never makes a profit? And you can't get rid of it because no one will let you. You can't be the London Stock Exchange and say, sorry, I think the AIM market's pants, I'm going to shut it, because the politicians can't contemplate it. So Pisces is not the London Stock Exchange. London Stock Exchange Pisces market is one of at least 3, if not 4. There's also something called JP Jenkins. You've got in America, you've got things like Forge Global. So the secondary idea, the secondary concept is growing globally because you've got this sort of just the sheer volume of need. Most of it, the volume is simply not big enough to really get what I'd call true pricing transparency, because there's just not enough volume of everything. Forge Global in America is pretty good. You can see, because they trade grey market shares in all the big unlisted US tech stocks. So they take shares off like ERS schemes and things and trade them. So, but do I think it's going to be the answer? It's going to be the answer to certain problems, but do I think it's going to be the answer to somehow giving founders more money? No, not for a long time, because you need to find the buyers.
I see. Thanks, Modwenna.
How many investors do you know? So I know Asset Match really well because I was a non-exec there for 9 years, and they had a group of super sophisticated people who understood what it meant to buy secondary shares in a small private company.
Yeah.
To give you a quick clue, this is probably a bit out of date, but it won't be madly wrong. Most investors buy, usually secondary market stocks are quite asset rich. So physical asset rich, not IP rich, because people can sort of get a handle on them. So they're things like companies which have like pub chains. You get quite, the other outlier is football clubs. A lot of football clubs trade on these markets.
But that's not a rational market, Modwenna.
Exactly.
Football clubs is not a rational market.
Exactly. But the ones where it's what I'd call a rational company, which is asset heavy, most investors buy in at 50% of NAV in the secondary market. So if you've managed to get your NAV from 0 to 200 and they buy it at 100, but you started at 0, you still made from 0 to 100. They buy at 100 and they're looking to sort of sell at 200. So you have to sacrifice that uplift from 100 to 200 to them in order to get your exit. Do you want to do that? Which is why it's not quite as simple as these. It's the sort of headline people and the people who are doing the PR and comms and being shouty. They're not necessarily looking at the really hard maths underneath all this.
Thanks, Modwenna. Does
that help?
It does.
Yeah.
It does.
I guess, Modwenna, I had this is quite new, so you may not be aware of it. So IM8, which is David Beckham's new drinks brand, which he launched at the World Cup. They had a very different way of financing that 1 billion from General Catalyst. And someone said this could be the future of the way people take money in. I would just love your thoughts on that in terms of, do you think it's a sustainable way of doing things?
Just forgive me because I haven't followed that one. Sorry, I'm not the biggest world football fan in the planet. I'm still working out how to spell it actually. But anyway, but yeah, tell me what the deal was, then I'll give you an opinion.
So David Beckham, obviously being a global brand, he's launched a drinks brand called IM8, and General Catalyst have gone in on essentially a funding of that billion based off the revenue that product will generate, and then they are kind of that plus margin and then out. So they believe that drinks brand will generate $1 billion, let's just say for argument's sake, but it might take 3 years on the payback, and then after that, Bex has got 100% control of it. So there's no equity play in here, there's no debt play necessarily. It's more like a loan into the system. It's the best way I understand it, but
yeah, no, I mean, you see these models at the top of the market. Clever debt, clever revenue share type things once it starts getting quite esoteric. So you've basically got equity or debt, and you've got, let's call it advancement of money. If you like revenue share, it's like advancing money against other money. So there are only so many choices. You can give it 400 different names, but fundamentally you're either an equity shareholder or debt. And even revenue share is sort of, as you say, it's a sort of advancing of a loan rather than. With that particular scenario, is it possible? Yes, because as you say, the brand is global and the sheer momentum might drag it forward. Is it that worth for General Catalyst playing that game such that it gets them loads of publicity? What's the free publicity worth? What's it getting to hang out with Beckham and the game? You never know with these things. You see the headlines, you never know quite what's happening behind the scenes. I've got a friend who invested in films, particularly do you remember the Sharp films? Sharp, the army guy from Waterloo, Battle of Waterloo, and he did it because his wife wanted to meet Sean Bean.
Who doesn't? There you go. But, yes.
Yeah, I wouldn't mind myself, but there we go. So when you're into this
Pepsi might want to invest. Perhaps Pepsi might want to invest in it. They paid him a fortune throughout the World Cup and previous to that.
Yeah, because just the advertising value.
But we are talking about the most iconic man in sports. And whatever he decides to do, he can get away with. And anyone else trying to copy that is going to be a serious struggle.
Yeah. I mean, I have seen these, as I say, I've been doing this game for 30 odd years now. And at the top of the market, you see these. It's probably more of an indicator of the top of the market and the pending, you know,
Collapse.
the pending collapse than it is an actual new way of doing things.
Modwenna, I've got a question for you.
Yeah.
Right? Now, you started the call with something I love, macroeconomics, stock markets and all of that. And all of it does affect valuations. It does. How do you feel Andy Burnham government, this is something we were covering in the previous, in this morning's surgery session, is going to potentially impact the marketplace for founders in the UK and what potentially could happen, particularly relationship with bond markets and stuff like that. Okay. How do you feel a Burnham government is going to support or not support founders with that?
Oh, that's an interesting. Okay, I'll try and take it from the top. Okay, first of all, macro events are far bigger now than our governments. Mr. Trump going to war with Iran affects the oil price or affects the ability to ship things around the world. That there are these, one of the things about COVID was when COVID ended, all the containers that things go in to go around the world on ships were all in the wrong docks. So there's a massive problem where it wasn't about COVID ending, it was literally everything was in the wrong place. And the whole global shipping industry had to move everything back around to a place where it could all work again. So you've got these big macro themes which no government can, in that sense, control. We can't anymore. Maybe in the 19th century we actually made the waves rather than saying we are. So there's only so much Burnham can do. I think whether Burnham can afford to change, I was been talking to some other people about this, given the fact that we've largely now got in most mature economies are very interventionist and, America's better, but it's still pretty interventionist, isn't it? I mean, Trump is not saying hands off, I'll give you all your back your taxes and let you get on with it. He's raising more debt. He's not particularly reducing taxes. So we're in a world where governments sort of control us. If you think about the UK economy, education, defence, health, roads and transport. What else can you think of? They are controlled by the government ultimately, most of it. So you've got this big hand of government, and I think the problem is I think any politician trying to actually really move the dial to a much more freewheeling economy, that's such a big job.
Any advice for founders? Any advice for founders navigating this?
So what I'd say for founders, I think there's a really simple answer for founders. Okay, now things like AI can do so much heavy lifting. Go and find customers. There's always a lot of talk about brilliant product, find this, find that. The grant funding market in the UK is changing dramatically, whether Burnham will try and change it back, but there's definitely now this focus on what's called IS8, Industrial Strategy 8 sectors. And if you're in there, you're in with a lookout, but all the grant funding and funding from British Business Bank, which is driving most of the strategy now, because it's such a big part of the market when it is a bit like a tanker. When it says turn left, if everyone else doesn't turn left, they're going to drown. So everyone turns left. So you've got this big macro things going on now. That also creates some quite interesting opportunities for people in the sectors they're not interested in, because actually that's where the private market free market could properly develop, which is, for me, it's really exciting. I'm going to go and play where no one else is because there's a lot of fun to be had. But in terms of can he make a big difference? No. Can he make a little bit of a difference? Perhaps. But I don't think, because of the way it's working, if you're not in the IS8 and you're not a shopkeeper who's going to have your business rates reduced, I can't see he can afford to reduce like employers' taxes. POE taxes, they're just not. So there's nothing we can all do about that. We're stuffed.
or a point was made this morning. If you've got a business with less than 5 staff, you're exempt from some of the employment legislation and some of the national insurance contributions. That could be a play. That could encourage. And bearing in mind that SMEs in the UK are responsible for 61% of employment, a stimulant for growth there, just to put a cover of protection over.
Do I desperately wish that they will listen to more voices? So one of the challenges has been in the last 2 years is the people in government have only really been listening to one voice, which is the scale-up story, which is great. I mean, of course, we need the scale-up story. I'm not remotely saying that shouldn't happen, but what's happened is that's been to the exclusion of other voices. And to have a healthy economy, we need lots of different people. We need to avoid cliff edge situations where people have no incentive to grow.
Yeah.
Ideally, we'd reduce taxes. Something that is worth knowing is because we do a lot of tax work around things like employment-related securities. So that's things like EMI schemes. You heard about those?
Yeah.
So we do a lot of work, and what we're seeing is a really interesting thing happening. So you often read about this tax gap where the government says we should be. I think it's currently they think it's about 56 billion. They think they're owed, which people haven't paid. And I read in the paper, I think yesterday, that the government's opinion is 62% of that shortfall is sitting with SMEs. It's one of the reasons they sort of don't like SMEs, because you wouldn't, would you? Because of course it's all what I'd call junk debt. So if they try and collect it, and if they really try and collect it hard, people just say, fine, I'll give up.
Yeah,
so
I'm seeing that.
Yeah, so there's not a lot they can do other than try and persuade people to cough up. So
Modwenna, but thanks for that. Now I want to go out to the floor. When you came on before, we had a brilliant session. There's founders in this room I know have got questions around valuation, fundraising, and that type of stuff. Raise your hands. Anyone want to speak to Modwenna about your situation and what's going on with the market, investor market or whatever else? Any questions?
I'll ask one, Ollie. A lot of the members within startups of Standup are small SMEs, as we know, and looking to scale. I think in answer to relation to when you get to valuation, I think every one of us has had to change the narrative that actually resonates with potential investors and be humble enough to say that we need to up our game and hire the right people in order for us to get that kind of investment. If you just say we're going to do this with our 4 people that we've done, we're going to take it from a turnover of, I don't know, 100 grand a month to 150 grand a month, that's not going to do it. If you can demonstrate that you really are trying to scale the business and there is a clarity of vision and there's a real addressable market. And actually, I think, having been in the city myself, like with Ollie, it's about managing expectations. Right? Don't say we're going to have 100% of the market. Say we really are going to be niche and we're going to have 3% market share, then they can believe you. And for me, it's never been solely about the money. It's about the people that believe in the journey, can come on the journey, can actually help open those doors, because they're the ones that are making the introduction to other investors or making the introduction to potential customers. So, and my last point is, when you talk about going back to the original thing on VCs and portfolios and the power law, etc., I think, and you said most of them, or not most, a number of people came in because they needed that company logo on their thing. The problem is, because valuation since COVID, 2021, 22 went up dramatically, certainly in SaaS models and deliverables, you then had down rounds. And because they were committed, they had to then top up other rounds, which were necessary as companies had rights issues, whatever. Right. So when these things happen, they're forced to top up or they throw the towel in. So for me, the answer has never been either VC. I don't necessarily believe VC is for everyone. And again, what I reiterated earlier, I don't believe listed company is the holy grail. There's too much risk. It's a different skill set to be justifying your quarterly numbers, and someone can have a go at you on the short side. You have to be a seasoned professional as opposed to a startup that says you can actually do this. That's just my thoughts.
Yeah, I mean, I think you can make these extraordinary journeys, but they are a very specific purpose, and you have to, if you want to take VC money, you have to play their game. There's no
You have to know.
Do you mind I'll do it my way?
You have to know how to play their game.
Yeah, you have to
know how to play their game.
You do, and you have to also be willing to play their game. So it's not just about getting the in; it's about the long journey. Where you've got to be on that, and a lot of VC investors relationships last longer than marriages, which is again something people often when you're relatively new, it feels like it's all going to happen super easy. But it's a long, hard slog. One of the best people I ever heard was Charlie Dunstone, who said, somebody said, why did you make Carphone Warehouse such a success? And he said, actually, what I did was I stayed sane. I got up every morning, I worked hard, had a nice meal in the evening, and I made sure I had a good night's sleep. And then I did it every single day. And guess what? Over time, it gets there. The sort of let's all work 14 hours a day, 15 hours a day, get completely exhausted, actually lose touch with reality. I mean, of course, for some people, they will go on this amazing journey, but these are vanishingly few. You know, they one in 1,000, one in 10,000. So whilst I'm delighted when they do it, I think for most people, you've either got to say, that's the journey I'm going to go on. It's going to be crazy mad, but it'll be worth it. For a lot of other people, you're going to have to find another journey. You can create value. I've just done some work for a company that's 400 years old. And I promise you, the family who still own it are having a very nice life. Thank you very much. Frankly, out of the public eye, no one ever asks them how rich they are. They just get on with their lives.
Because they kept it simple.
Yeah, kept it straightforward, and they've kept the culture and values going, which is a thing. Again, a lot of founders can get lost in we're trying to become billionaires. But I think you were saying about you must be doing it because you want to do the core activity. All the most famous people I've met, and I've not met by any means everyone, but I've met enough who've been very successful. None of them do it for the money. The money is the byproduct. That's the proof of their success. But they would sort of start again tomorrow if they wanted to, because they're doing it for the intellectual satisfaction of whether it's having the idea or delivering the idea or whatever is most. And often there being something that's driving them is something in their past where for some reason somebody didn't understand them. And it's almost like I've got to prove to this person.
Prove again. Yeah.
And prove again, which is why some of them are never quite stop, because, you know, often the person who they need to prove it has died, so they can't go and say, oh, Yabu sucks, look, I did it, mate. They're having to talk to a dream, effectively.
I think the most successful ones are the most humble.
Yes. Yeah, definitely.
And that is, and again, I think it's a bit of a fashion parade as well when you're taking in money. Yes, you may be desperate, so therefore you have to have those conversations early and try and line them up early. But I think what one needs to do their due diligence, you should be able to speak to 10 people in there, 10 companies in their portfolio. Do they add value?
Yeah.
I think that's it. The terms may be in their favour because of preference and payouts, etc. But if you're going to take outside money, look them in the eye and throw it back at them.
If you've got customers, you're making sales. If you're making sales, can make a profit. People are going to start wanting to talk to you about investing in your business.
Thank you.
Thanks, Neil. Eddie.
I was just a bit curious on the 400-year-old company. Do you know if they had any like tricks for keeping it going that long, like through the generations?
Yeah, they're really amazing. So first of all, they don't shout and scream. They're very quiet, modest people. They just get on with what they're doing. So they're not having to deal with the washback from being shouty. So if you're out there being shouty and screamy, you deal with a lot of washback from people sort of getting in touch with you. They're not wasting any energy on stuff that isn't to do with the business. Does that make sense? The other thing they do is they still have, on the original site where they do what they do, they still have a house. And with every new generation, the older family member, older family leave the house, and the new generation moves in, brings up their children literally on site. So for generation after generation, the children grow up understanding exactly where the family, how it makes its money and where it makes its money.
Wow, Very interesting.
So they haven't all, just because they have got a lot of money, but they haven't gone off and all lived in mansions elsewhere. They literally put the key family, who are going to be the next generation running it, on site.
Are they
from
not?
birth. Not going to say it's private. They also have a lot of cross ownership. So they deliberately make sure that assets are owned by several members of the family, not just one. So this forces them all to stay together.
But on that, they've had a succession plan.
Yeah.
That's why they've been for 400 years. With all due respect, I can't live on the same road as some of my family, let alone on the same estate.
Well, precisely. So you have to have a culture.
Yeah.
And you have to have values, and you have to have a way of thinking, which is about keeping this going. I think you probably noticed that Russell and Bromley recently went bust after 5 generations. They'd managed to last, 100 odd years plus. But then one generation it does go wrong, but it's quite rare. So there are lots of different models to be successful. And I think one of the things I see so much is, it's all about VC fundraising. It's like, well, make your customers happy, then they'll pay you.
Yeah.
Keep as much equity as you can.
Keep as much equity as you can, because once you've sold it, it's damn hard to get it back again.
Absolutely.
And also, the minute you're now, I think the other thing is, I think people talk about VCs and things. What I think about things is your shareholders, you're all co-shareholders with different size shareholdings. I think that's something people often don't think about. They don't think of it that way. But if you actually think you're effectively inviting them into your family permanently.
Mm.
And by the way, there's no guarantee they'll actually send the person you first met who you thought was great. You might find that their person they're putting on your board is someone else entirely. Mm. And all these things you need to be, I'm definitely not saying don't do it. Do it. For some people, it is absolutely the best possible way to grow things, but it's definitely not the only way for everyone. And most people, it's not going to suit. Mm-hmm. Because by definition, it's a niche with a very specific single objective. And if you can't give them that, the minute they think you're not going to give them that, they will go X on you. Because the general rule is chase your winners and drop your losers.
Yeah.
Modwenna,
any final question?
I was just going to say, on Modwenna, on that, and thank you, you've dropped some real gems as always. But do you think many founders, startups understand the possible pitfalls? Because I think a lot think that it's great, let's raise, don't even always know what they're going to do with the money they've raised. And I've heard, and some really big names have actually lost their companies.
Because it's a very hard world out there. Yeah. This is the other thing. People think it's not unkind. It's just hard. These people are hard because they've got a very specific objective. It's not all soft and fluffy. But with AI now, genuinely, we're beginning to adopt AI. For 15 quid a month and Claude, you should be able to get your business up and running and be selling things, unless you've got a very hard physical manufacture job. But if you're in any sort of thing which is basically a services type, software-y type business now, we're just working on basically giving up having software developers completely. We're just getting Claude to tell us what to do.
That's actually really interesting, because we've got a few people in Startup to Standup who are selling that kind of service, but you've probably answered where some of their pain points are, those that are selling AI services. Yeah. That there's a mix that people can do themselves with Claude and ChatGPT.
Yeah. And so the old idea where, 50 years you literally couldn't get off the ground because somebody had to finance your factory to make your product. Then we moved to software, and you can't get off the ground because you have to have the specialist software developers to develop the software to get your product off the ground. Well, now that's just changed, hasn't it? You just don't need, you really should be able to. I've got a guy who's trying to take out Bain & Co. with AI and himself. Which is, I think it's fascinating watching what's going on.
Yeah.
But, that's an extreme example. But everyone now needs to be just completely changing their mindset and saying, hang on, can I do it for 15 quid a month with Claude?
Yeah.
And I think once you start asking those questions and start looking at what you're doing, and I mean, people are now getting Claude to have like, you have, I'm your executive assistant, Claude. I'm your bookkeeper, Claude. I'm your, marketing director, Claude.
Yeah.
So,
I mean, that's how I'm using it. By agentically and creating agents. Yeah.
Yeah. So frankly, that is not, that you should be able to get a lot further on your sort of sales and profit journey than you ever could before.
Before they then need to take on investment to scale. Yeah. Good point. Thank you, Maria.
Modwenna, it's been fabulous as always. You've shone the light on a lot of stuff, and it's been fabulous. You're going to get a lot of love in the next few days on LinkedIn from us. Look out for that. Be prepared. And you're always welcome back. We love having you, and it's very good. Very good.
I'm just going to give you one warning. The tax man is definitely using AI too.
Yeah. Oh, completely.
So I'm going to give you just one warning story. 2 founders 5 years ago running a business. They decided to swap their shareholdings because, frankly, it was their business. It was in the pub, and they got on with it. And they filed their new shareholdings at Companies House and got on with their lives. Last year, the seller, so the guy who sold his stake to the other guy, to move it around, he got a letter saying you owe us £5 million in capital gains tax. I think, did I tell you this? So
no, I read about this. This is in the press, isn't it?
So what I'm saying to all of you is you've got to be very aware of your actions, whether it's moving assets around, shareholdings. Remember, the tax man is now looking to identify where they can prove there's things like capital gains tax to pay. So when you're doing this stuff, do not be tempted to just do it on the cheap and cheerful, particularly if you're playing with shareholdings. Make sure you work with lawyers and people who can advise you properly on this stuff, because even though in theory you can do it all automatically, it's the one area where the consequences could be very expensive in the future.
That's why we're sponsored by Vested, and we encourage as many founders to go and speak to them as possible and do it properly. We had a whole session by a lawyer at our event hosted by Barclays Eagle Labs last week, Modwenna, and it was on shareholders' agreements and getting it right. Very noted. Love the talk. Thank you very much, Modwenna, and you're welcome back anytime. We love having you.
Well, good luck, everyone. Go win. Looking forward to seeing all of you on the front pages of the business press.
You will do.
See you soon. Bye.
Thanks, guys. Bye.